this is the second time the Dream Team's been together so far this year, the three of us, and I'm glad we coordinated with our all red shirts.
Mine's a little brighter, but that's all right.
Yeah, well, you're always trying to get the attention.
Is that red in honor of Indiana University winning the college football championships?
I think that's what we should say this morning.
Yeah.
That is, well, it could be. It could also be that it's signifying what's going on in the market, too.
That's true. That is true. What is going on in the markets, David? Tell us.
From what I hear, from what the interweb tells me, the interweb says that the market is down like 1.5 points and trying to struggle back a little bit. What do you think it is? Do you think it's hey, we're going to attack Greenland? Is it, oh, wait a second, we're going to send in the army to settle some things down in Minneapolis, which can't figure out whether or not it's the most corrupt city or the most lawless city in America? What do you think it is? What's causing all this uncertainty?
I think it's actually, believe it or not, what we talked about the last time the three of us were together, and that is the David Tepper rule. The market can handle one or two, maybe three uncertainties, but when it becomes 4, 5, and 6, the market can't handle that. And I think that's where we are right now. Obviously, what's happening in Japan with the JGBs is not conducive because it's pulling our yields up. But, it's also, we talked about pay to play. That's what I wrote about this weekend, and the consequences of pay to play. A government that is, sort of forcing capital allocation schemes. Do you want our government picking winners and losers? And then obviously the renewed tariff threats over Greenland. So it's a multitude of things, and the markets abhor uncertainty, and the more uncertainty you have, the markets are going to react. And whether it's our independence of our Fed or ultimately, I think this comes down to, in my mind, we've got very aggressive earnings estimates for the S&P 500 that are dependent upon margin improvement, and I think the margin assumptions are over 13% near record highs are very suspect this year. And so it's hard to see where you get multiple expansion this year, particularly if long rates go higher. So you really need the earnings growth, which right now is mid-teens assumed, and that mid-teens is dependent upon margin assumptions, and I think those margins are very vulnerable to disappointment. So I mean, there's so many things we can talk about. I just wanted to rattle off a few things.
So I have to ask you, Charlie, since you are our financials expert, I don't know why I hear an echo. I don't mind hearing myself twice, though. That's pretty good. Jay Powell, does he lose a little bit of credibility going to the Supreme Court hearing, or is he fine? Is it too political to go here? I mean, obviously, he can't do anything about it. He's injecting himself into the dialogue everywhere this morning of, he's going to attend the Supreme Court hearing on whether or not Trump can fire a person in the Fed. Or is it, no, look, he's a good manager. He's going to be watching out for one of his employees.
It is political at the end of the day for him to do that. Is it appropriate? I think he's reached that point where he's crossed the Rubicon with his, statement a week or so ago in response to Trump's, indictment. So I think he's already crossed the Rubicon, and this is just an extension of that. But yeah, it has become political. There's no question about it. But he's fighting for the independence of the Fed, I think more so than his own legacy. And I think that's an appropriate fight for him to take on in his last 3 months or 4 months of service.
A lot of headaches. All right, so let's talk about banks and oil and gas. And I know a couple of oil and gas companies are up today. Meanwhile, it's freezing cold here in New Jersey. So, Charlie, tell us first financials. You sent in some slides. What are we looking at? What are we talking about today?
Well, the big winners this year and last week were the capital markets names. The Goldman Sachs, the Morgan Stanleys, partly because the backlog, the pipeline of deals is at a 4-year record high, and these names did not have any credit card exposure, so they didn't have that risk of a cap, and they have big wealth management operations. So everyone was very bullish on the capital markets names. And I wrote over the weekend that this year was likely to be characterized by, increased volatility and potentially some black swan events, and that this optimism around capital markets names was probably at risk. And so let's talk about Jen, if you can put up the very first slide that shows the capital markets revenues from the fourth quarter, give you an idea of the setup here. So we had very strong year over year capital markets growth. The top table shows total capital markets revenues. That's both trading and investment banking, and you can see it was up double digits on average. That's that right-hand box, up 12.4% on the top table. And that was driven largely by strength in investment banking, which is the higher multiple part of capital markets. And that is, that's the lower right-hand box in the bottom table showing investment banking revenues, which is, investment banking revenues are M&A advisory fees, equity underwriting, and debt underwriting. And so, people wanted to pay up for those types of revenues because they're higher multiple of those investment banking fees. And the pipeline was strong and the growth is pretty robust. So we had a setup here where stocks were being priced for perfection. I mean, if you take Goldman Sachs, it's trading almost 3 times its tangible book value of $335.49. I haven't seen that in my career, and I've been around for 45 years. Maybe we saw it temporarily.
Say that again, since it's so rare that you've seen it.
I haven't seen these types of price to book valuations in my 45-year career. Maybe we saw it temporarily going into the great financial crisis. But Goldman Sachs, people are thinking they can earn $57 next year, so it's trading at 17 times next year's earnings. That's a rich multiple. I mean, typically these things trade maybe 12 to 14 times. So there's a lot of optimism here. Now, rightfully so, these guys are being deregulated. They have excess capital. They're buying back stock. The revenue picture is pretty robust. So it's hard not to like them. But the valuations say all the good news is in there. And it's been my expectations that we're facing peak capital markets revenues in 2026, with the first quarter probably, if you annualize it, being the best quarter of the year. And partly that's because trading revenues seasonally are strong in the first quarter, and then you get all the investment banking revenues that were postponed in the fourth quarter because of the government shutdown hitting into the first quarter. So if you take that first quarter and you annualize it, it's probably going to be the best quarter of the year. And I won't talk about what I've said before, but it's my belief that you're seeing this mature phase that suggests that it's peak revenues. So the question becomes, what do you want to pay for that? And I'm not willing to pay what's being asked. So that's the setup. Now you've got these disruptions in the capital markets. I mean, what's the S&P down 100 plus points? JGBs are up 20 plus basis points. Our own 10-year yield is starting to break down. So you're starting to get some dislocations. And that raises some questions about who's exposed to these things. There's commentary out there that in the precious metal markets, just year to date, because of the rally in silver, there's 30 billion of losses on dealers' balance sheets from that type of thing. So, these are all, things we hear. We don't know for sure where the problems are developing, but when you get these kind of dislocations, there are usually hits taken in the capital markets area. So if we can go to the next slide, Jen. what I'm posted here is the next two slides, and we'll stick with this one, but the next two slides are going to show sort of what I call the financing revenues that Goldman Sachs is generating. And I give it to you both in terms of line of business, which is this slide, and then in terms of product type, which is the next slide. But let's stick with this slide. If you look at the line of businesses at Goldman Sachs, there are three. There's their global banking and markets business, there's their wealth management business, and then there's their platform solutions business. And what I'm showing you here is their net interest income. And you can see on the top line, the net interest income or their financing revenues that they generate from these businesses is outsized in their global banking and markets area. And the growth in that specific business is outsized relative to others. The reason I point that out is what this is reflecting is growth in their counterparty exposure. In other words, they're financing counterparties who are out there leveraging and trading and investing in these markets. So while this is good, revenue growth, it does say that counterparty exposure is growing by leaps and bounds. And
so so to break that down to some of the people that might be listening who have no idea when you say counterparty, you're saying things like a hedge fund or a company that is either hedging or is involved in the public markets, maybe even commodities for that matter, but in the public markets, they when you send them your money, let's say they have $1 billion of different people's money, different endowments money. They're not investing just that billion; they're investing like 5 billion.
exactly.
But they have to borrow that. They have to borrow that money from someone, and they borrow that from a Goldman Sachs or from another bank. Is that right?
Exactly, and thank you for putting that in simpler terms. But yeah, that is it in a nutshell. So they are financing the excesses in this market that the hedge fund community, private credit, private equity, and others are deploying in their own trading operations.
So back during the financial crisis, people were running like 5 times levered or even higher. How bad does a market have to get before a Goldman Sachs or some other bank starts to say, "Hey, listen, I'm not comfortable with your leverage. We need to bring that down"? Or is that mostly the hedge funds doing it themselves?
Yeah, it's usually the risk manager within the hedge fund that taps on the shoulder of the portfolio manager and said, "You've lost enough money today. Shut it down." And that sort of deleveraging is what I'm expecting to affect these financing revenues. So right now, people believe these are annuity sources of income, and Goldman Sachs is trying to sell that story or that narrative to the street analysts, saying this is steady annuity source of income. And my position is it's very cyclical. And as soon as the deleveraging is imposed on the market, this source of revenues is going to turn down. And that's why I think you're paying for peak revenues right now. I think we're going to see the volatility this year pick up, some black swan events occur, and a lot of the players out there that Goldman is financing are going to have to deleverage, and this source of revenues is going to turn south. So if we can go to the next.
It's not just the market going down, it's also just this volatility of having, if these hedge funds are positioned one way and you have a drop of 1.5 in the market one day, and then you've started this year with a really good run, that type of volatility also just creates havoc because they don't know where to go. Is that right?
Very much so. And where you'll see this is in the next slide, Jen. So the first slide was by those financing revenues, the net interest income by line of business. This shows it by product type. FIC financing is fixed income, commodities and currencies, and equity financing is obviously trading equities. And what you're going to see here is that the growth in equity financing has started to accelerate relative to FIC financing. That's important for two reasons. Is, as I've said in the past, when the drivers of capital markets revenues transition from FIC or fixed income to equity, that characterizes the mature phase of the market. The mature phase of the market, of capital market cycle, usually is associated with increased volatility. But what we're seeing is the prime brokerage business, which is what supports a lot of the equity financing, is growing dramatically at Goldman Sachs. So another indication that their counterparty exposure is grown significantly. So to me, you can have one of two outcomes. Either there's a deleveraging and financing revenues go down, or a counterparty blows up, such as we had, what was that hedge fund? Began with an A, funny name. Anyway, Argonaut, or no, it wasn't Argonaut. Anyway, where you take principal losses because the hedge fund or counterparty goes under. So I think the risk rewards do not favor owning these capital market stocks, and I would definitely be either avoiding or selling them.
Yeah, so one way to think about it is like if you look at the chart that you have up there, that 1.6 billion in the first quarter of 26 became 2.1 billion. So you're growing tremendously on this equity financing business. How long does that stay good, right? Because that's on the same number of people, right? They didn't hire 40% more people to do that. And so are they over earning is really what you're saying, or you're saying like, yeah, they're not over earning in a fraudulent way. It's just, no, things are really good right now. There are lots of ways it could not be good.
Yeah, I doubt it gets better. The first quarter, as I said, can get better, but that's probably the peak. That doesn't mean that revenues have to fall 30% or 40%, but I don't think it gets any better. And given the valuations, I'm not willing to pay up for peak revenues.
Bob, remember the times at the banks when things were good?
Hey, Charlie,
Yeah.
you mentioned that the banks are trading at peak optimism, but kind of along your theme of pay to play, what is the risk of the recent reports that the Trump administration may restrict allocation to dividends and share buybacks by the banks in order to redirect that capital to more, financially friendly areas? They've already, announced perhaps targeting or capping credit card interest rates at 10%, but there could be further moves, like has occurred in the defense industry, to try and loosen up the capital markets for housing or other areas. How much of a risk or possibility do you see that?
I think it's significant. And this is actually what I wrote about over the weekend. I mean, I started last summer talking about there's going to be a moment in the banking industry where the pay to play requests are going to come in. And we've started to see that in spades. So back last summer, I speculated, and this is all in my writings this weekend, which I'll post on Wall Street Beats later this afternoon. But I speculated that the banks would probably be asked, to buy treasuries in response to the capital relief that they're being given in the deregulatory, soft touch that they're being offered. So that's the pay to play. Give them the capital relief, deregulate the banking system, but in return now you have to give the administration something. So there are a number of areas where I have speculated that they would be asked to help the administration. The first was to buy treasuries to support the deficit financing. That obviously has not been a real issue because bonds have behaved themselves. Now we're facing a situation where it looks like the 10-year yield is starting to break down for a host of reasons. And we'll see what happens if we get, back up towards, a 4.75% or 5%, 10-year yield. There is an expectation in the marketplace that yield curve control will be imposed, and therefore the banks may not have to play that role. But what you don't want to see is the administration using our banking system the way the third world governments use their banking system to finance deficits. So that's the first area. The second is, this is probably less well known, but JP Morgan Chase committed 1.5 trillion to spur economic growth and innovation to make this world, quote unquote, more secure. They called it its Security and Resiliency Initiative. And if you remember, Todd Combs from Warren Buffett, came on to JP Morgan's advisory board to run this portfolio. But in my mind, this was JP Morgan's, staying one step ahead of the industry, which they always have been, by the way, and saying, listen, we know we're going to be asked to do our patriotic duty to secure security and critical minerals and strategic, plays. So let's get ahead and do it on our terms rather than doing it on the terms being requested by the administration. But at the end of the day, what they're doing is responding to a likely capital allocation that the government's going to demand of the banking system as to where they put their capital. And I don't think capital allocation schemes end well. That's my bottom line on that one.
The first $10 million is going toward a Davos bar tab, from what I hear. So
the next area obviously arose when Trump demanded that the defense industry pare back dividends, buyback, and CEO compensation, and reinvest that capital into production capacity, modernization, and faster delivery of weapon systems. And that the obvious, and by the way, I think the same thing is being asked of the home builders. Stop, buying back stock and get back to, building homes on the multiple lots that you have. So to me, it's likely that the banking industry will also be asked to reduce buybacks or stop buybacks, and that's important because that's accounting for anywhere from 3 to 6% of their earnings per share growth. I mean, they are literally turning high single digit earnings growth into mid-teens earnings growth through share buybacks. So it's a material event for them, and towards to support that assumption, Wells Fargo on their earnings conference call here in January said that buybacks in 26 would be lower than what they did in 25. And yet Wells Fargo is one of the major banks with a lot of excess capital. So they're kind of sniffing out that this request is coming their way.
I'm afraid the bank CEOs that make $20 and $30 million a year, where will they, if they can't attract talent, who's going to do that job of being a CEO of a major bank for half that price?
20 or 30 million. You've obviously missed the headline of Jamie Dimon's 700 million.
Yeah. So who'll do that job? I mean, we'll run out of CEOs.
I'll do it for 25 million. How's that?
Do I hear 20? Can we do a reverse auction here? Bob, are you good for 20?
I'm good for 20.
But the last thing I'll mention, obviously, on this pay-to-play theme, because I really do think it's going to hit the industry in spades this year, is the 10% interest rate cap. And at the beginning of last week, most people said this is not going to happen. Don't worry about it. By the end of the week, the institutions I was talking to, the major banks said we're giving it more, concern as it's going to gain populist support and some momentum. And then finally this week, we are going to get in Davos from Trump his affordability plan. And that affordability plan is going to demand that certain parties participate partly to their detriment. So this government theme of pay to play and intervention is something I think the markets are very worried about because it's going to affect margins.
It's really interesting that he's taken this tack of pay to play on like the defense industry and the others, but he didn't do it with pharma, right? It's interesting. He said, okay, you need to lower prices, but he didn't say anything about CEO pay, didn't say anything about buybacks. Today we had another multi-billion-dollar acquisition, which is being, I've said this for a long time. These acquisitions are being done with patient money, like with sick people's money. And they say, okay, well, that's profit, it's whatever. But remember, that's government, that's taxpayer money, because about 50% of all the U.S. sales are taxpayer funded. So it's interesting that you're right, he's picking and choosing who's gonna pay with at least bully pulpit, hey, I want your pay to be in focus, which is uncomfortable for these CEOs who have seen violence against CEOs. We've seen protests and the rest. The last thing they want is their name in the paper and how much they get paid. So it's
Well, yeah, I mean, you saw what happened to Wood at Exxon. He got, quote unquote, excommunicated from Venezuela for his rather honest comments.
Right. The Venezuela was uninvestable, which he was right at this point in time. I mean, so, they've had their asset repatriated twice. Third time is sort of shame on me.
No, but so I actually think that he should have been smarter on that, right? Because I'll take the counter of that. It's like if your spouse asks you, does something look nice on them? Your answer isn't no.
You lie.
You,
You lie.
you might say something like, well, the red one is prettier or something like that, but you certainly don't say, no, that's hideous. Like, you just don't. So he put his foot in his mouth, and he'll just have to pay extra to play. But all right, well, Charlie, I think it's super interesting because it's so unpopular to call, hey, things are really good right now. They're not going to be good forever. And you're even saying like this next quarter might be really good in some of these aspects as well, but this is the time to either fade out of it, to take some profits, to look elsewhere. And that's really unpopular to do. When the party's going, no one wants to hear someone say, hey, let's wind it up.
Yeah, to bottom line all of this, I think we put in some kind of peak in the capital markets names this quarter, and we're down by 30% by May, June.
Wow.
Well, with that happy note, and by the way, for all the Bitcoin folks who watch and like want to chime in, how's it going today? So with I'll just
I don't know who that's
troll.
Was that directed from family or to
No,
general
I'll just troll the people that always say like, oh no, it's an asset that doesn't move with the market. It's a countervailing force. It's a highly speculative vehicle used for a lot of illegal activities. So good luck with that. But Bob, let's move to oil and gas. Should I be buying more oil and gas stocks because it's so cold out?
Yeah, it's interesting. Go ahead, Charlie. You were going to say something?
I was just going to end with, on your Bitcoin comment. I think both Ben and I and Wall Street Beats in general, you include Bakes as well, have been saying for a long time that we thought precious metals would be the risk-off asset to own, not Bitcoin. And I think that's proving out to be true in spades. So congratulations to Wall Street Beats for that position.
Yeah, up 3% today, right? I mean, this is versus down 5% for Bitcoin. That's a good spread.
Mm-hmm. And I think now you can put energy in that risk-off basket for some reason. So I'll leave that to Bob to figure it out.
Yeah. So we were on Friday and we said that as far as oil and natural gas prices grow, it continues to be a headline-driven market, and that's certainly the case today with oil up, just on the concerns around what happens with Iran, what happens with the uncertainty and everything that's going on around the world, Venezuela and so forth. And so, our view has consistently been that oil is going to hang in here around $60 a barrel. It won't go to $50 a barrel. And that continues to be the case. There's always going to be these crosswinds of headlines, different things going on around the globe. But more importantly, we were on Friday and we said, wow, natural gas is really taking a hit here. It's down 35% year to date. The year-over-year storage deficit turned to a surplus last week with a lower than expected withdrawal from natural gas storage inventories. And the weather was warm. Well, here we are 4 days later, and the weather is cold. And the weather forecast changed over the weekend to where we have this cold Arctic front coming down across the U.S., and it's frigid weather here. And guess what? Natural gas is up 25%. And at the same time, apparently, there's not a lot of wind blowing in certain areas that blow those windmills. And so we have less renewable power that has to be supplanted by natural gas fired power. And so all that's contributing to this 25% move up in natural gas prices today, which is the biggest one-day move I think we've seen in quite a long time. But that's given a little support to the natural gas stocks. And I said on Friday that just given where we were in the winter, past the midpoint of winter, and where storage was and what the weather forecasts were, on half my position in Expand Energy, I wrote April 105 calls. I said I was waiting to see how the market played out to do anything with EQT. So this morning with the early move up in EQT, I wrote March $55 calls on half my position in EQT. Just trying to play it safe here, and with the view that unless the weather stays extremely cold, as we get to March and April, that's the shoulder period where natural gas prices typically dip and the stocks along with them, because there's no real heating or cooling load demand. we're coming out of the winter. We're looking at where storage levels are and what we need to do to rebuild storage then going into next winter. And so, apart from a sustained below normal weather forecast, I think that's was sort of the smart mover is to sort of hedge some of the position on these gas lever names. I still like Expand Energy. I still like UQT. I don't think that the stocks will get called away from me come March, April, but we'll keep an eye on them and maybe I'll roll those calls or we'll see what happens. But it's just taking in some good premium in writing out of the money calls on half my position in EXC and EQT. And again, I'm overweight those names. I still like them long term. Otherwise, I'm holding on to the oil names. The names I'm continuing to look for any pullback to add to positions.
So Bob, you're looking to add Schlumberger and what is it, Valero?
Well, I started positions in both those names, and then with the whole Venezuela situation a couple of weeks ago, the stocks shot up before I finished getting a full position. So I'm still looking to add to my names or my positions in Valero and Schlumberger. I don't have a full position in either one, but my cost base is a lot lower than where they are today. So I'm just watching those as far as adding to any positions. As I mentioned earlier, doing a little risk management around the gas-focused names, writing out of the money calls, and then otherwise just sticking with the oil names here. The other thing that I didn't mention earlier is that what's positive for oil is the whole demand side of the equation continues to improve a bit. And that the latest news today was that China's GDP last year was better than expected. The forecast is for better than 4% GDP growth there this year. So that oversupply in the crude oil market globally that everybody was worried about last year in 2026 continues to tighten up a little bit here, which has been good for oil prices. So, that's underpinning some of the strength along with the headlines in oil. Of course, the other side of the equation is if, with this whole situation on Greenland, if a trade war breaks out and that dampens the global economy or global growth, that would, be a negative for crude oil prices. But right now, with all the data we've been getting with earnings season with China and everywhere else, the strong global economy is continuing to narrow that oversupply for 2026 on crude oil, which remember, we expected that then to tighten further in 2027 and not be an issue then. So that's helping out there. In the meantime, just watching for shifts in weather forecasts here for what's half of the winter left to go here as we go forward. So that's sort of where we are in our positioning right now.
All righty. Well, in healthcare, it's really boring because there's nearly nothing coming out for another little while. We have J&J and Intuitive Surgical and Abbott this week. Then you have another dearth of anything next week, and the large pharma reports a week later in the first week of February. So you have a little bit of time to position there. On those three, I'm not involved, but all three have been doing pretty well, and I can't imagine there's not been a lull in people getting sick and the government paying for things. So, Intuitive Surgical's been blowing it out lately, so not bad. But again, I'm not involved in any of those. I'm not deep on them. So, take anything like that with a grain of salt. I did mention that my little Japanese hedge has been doing well, exactly what it's supposed to do. Domestic focused players. I think I mentioned a few weeks ago that I bought about 20 names, all that should do well with a strengthening yen, and by and large they've all done pretty well. So I had a spice company yesterday go up 8%. So if you want to talk about luck, that's pretty good. You buy essentially a home cook spice company, and it does that. That should be a boring name, right? A very boring name. But in this market, that's doing well is boring names. So today you see Halion doing really well. Why? Because it's boring. So here's to boring, and not insulting you, Bob, by saying that, but here's to boring. Let's call it a day. This is Wall Street Beats. If you're interested in seeing what we talk about behind the scenes, some of our other trades, just go to wallstreetbeats.com or passes.com/wallstreetbeats. We'll see you later in the week.